In this video, you'll learn how to invest in real estate step by step for a beginner. I'm going to take you from A to Z, exactly what you need to do. Now, in my career, I have bought hundreds of houses. I have owned up to 30 rental houses at one point, and even today, our firm, Evernest, manages thousands upon thousands of properties for investors who live around the world. So why real estate? Why would you want to invest in real estate? Well, everybody thinks about cash flow, but there are other things to consider. Number one, I think it's a great hedge against inflation. Like, it tends to increase. Rents have increased over the past several years where we have had inflation, and not only rents, but property values have increased. So a lot of times it's a great hedge against inflation. There's also always going to be a demand for housing. People have to live somewhere. And we know that even in a down market, there are still people who are renting houses. Our company got started in 2008 in the midst of a big downturn, a financial crisis, and we were still renting houses, and we have rented houses for the past 16, 17 years. And so there's always going to be a demand. And this is the whole supply and demand thing. There's high demand, and right now there's low supply. So it makes a lot of sense. And then we all know that the wealthiest families in the world have a portfolio of real estate. It's a great way to diversify not only your income sources, but also just your retirement assets. And so these are some of the reasons we love real estate. So what should you buy? You need to be really, really clear what you should buy. So I'm going to eliminate two of these things real quick right here. Firstly, I want to eliminate commercial property. I think this is a big leap for a rookie investor, somebody who's just starting out. You don't need to even think about commercial real estate. There's a lot of things to consider, but we don't even need to go into that because commercial is not going to be for the beginner. Next, you have apartment buildings. I would just say multifamily is more risk. And so what you can do is you can learn so much just taking it slow, one rental property at a time, single family, and you can build up to buying maybe a multifamily down the road. But I would just say buying multifamily right off the bat is not the best move for beginner real estate investors. I actually bought an apartment building early on in my career, and it wasn't a good move. We actually lost money on it. And so I'm encouraging you not to do that. So that just leaves us with single family houses. I think there are a lot of reasons why you should invest in single family houses. So let's look at these. Number one is just stable income. Even if it's not a massive amount of cash flow, it's still, once you have a signed lease for 12 months or 24 months, pretty reliable. If you've done your due diligence, you've selected the right resident, you're going to have this income coming in. And so it's a reliable source of cash flow. Next, liquidity. If you need to sell, you can do this. It's going to be much harder to sell a commercial piece of property. It's going to be much harder to sell a multifamily property. It's just a different ball game. But a single family residential property, you can sell. It's more liquid. So if you had to get your money out of it, you could. And then next, again, I just mentioned this, it's less risk than buying multifamily. You need to, as a beginner, as you're starting this thing out, you need to mitigate risk as well as much as you can. You need to get rid of the risk. And so buying one at a time makes a lot of sense. And then we all know that there are tax benefits. Not only is there cash flow, but you are able to write off on your taxes the mortgage interest, the property taxes, the repairs. So for a lot of people, it acts as a great tax benefit. So these are the reasons why I love single family houses. And then lastly, we all love this trend right here. Over time. If you're trying to day trade rental property, it's not a good idea. If you have hey, I need extra cash flow for the next 2 years, I would encourage you, don't buy real estate. Do not buy rental property. This is a long-term game. This is not a get rich fast. This is a get rich slow game. But as you can see, look at this right here. Look at this downturn. This was 2008. And this was a big financial crisis right here, but over time we saw this huge dip. I'm telling you, I was buying in this time, and it seemed like the world was falling apart. Everybody thought that it was never going to recover, never going to recover. And so if you were an investor in this time and you sold everything you had, well, guess what you missed? You missed this incredible appreciation that we've had. And that's why I encourage people over time, hold on to this real estate. Again, everybody needs to live somewhere, and this is a fantastic investment. All right, so let's start off with the first step. So the whole thing is going to be the first steps. This is what I would do if I was starting over from scratch. So the first thing I'm going to do is I'm going to set goals. To me, I think in 10-year is the first thing that you want to do. What's my 10-year goal? And it could be I want to own 10 rental properties. It could be I want to own 50 rental properties. Whatever it is, set that goal, set that target. And then what you want to do is you want to work backwards to your 5-year. Now, what needs to be true in 5 years? A lot of times it's not going to happen just the way you think it is. So if you said I want to own 10 rental properties, by year 5, you don't have to own 5. Right? It may be you own 2 or 3, and then it starts to increase exponentially as you start to understand what you're doing and you get better at it. Or it could be you want 60. Well, year 5, you may not be halfway there. So start with your 10-year goal, then work back and say, okay, what needs to be true in 5 years? Understanding that the first 5 years could be an incredible learning experience, and you may become just a great buyer of rental property. And so then figure out what your 5-year goal is. And then what do you need to do in the first year? What do you need to do in the first year? And what I like to do with my goals is once I have that 1-year target, I break it down quarterly. What needs to happen this quarter? What needs to happen quarter 2? And I just take it 1 quarter at a time, and I build and I build and I build and I build. I believe that Stephen Covey says this: people tend to overestimate what they can do in a short period of time, but they tend to underestimate what they can do over a long period of time. And so 10 years, I think, is a great starting point, and you're probably going to underestimate what you could do. But this is the way I would start. Decide, again, how many properties you want to own. Is that going to be 10, 20, 50, whatever the case is? It's up to you. It's just really a lot of this is going to be based on your desire, because I will tell you there's no shortage of ways that you can invest in real estate. There's no shortage of strategies. There's no shortage of money out there for people who really want to own real estate. So even if you don't have any money, you 100% can find the money and be an investor. And then these are the avenues. Now, I'm talking about long-term. This is what we like. We love long-term rental property. It's just more predictable than anything else. I started out wholesaling. So when I was buying houses, I was buying and just flipping these houses to investors. And this is the way that I started building up a reserve of cash so that we could buy rentals, is I was just wholesaling. Now, the way we were wholesaling is we got a line of credit at the bank, me and my partners, and we were paying cash for these deals. So we weren't just assigning contracts. We were literally closing on these houses. Now, we may turn around the next day or later that day and sell it, but we were always going to close. And that was our biggest selling point to people who we were buying from was, we'll pay you cash and we'll close in less than a week. We will close. I don't care if we don't have another buyer, we will close. And so this is the way that I started. I have a lot of friends that do house flips as a way to build up cash reserves. They're a lot more involved, more risk involved. They cost more money because you're paying for all the repairs. You have to actually own the house, purchase the house before you do all the repairs. And then there's the risk of it sitting on the market. If you've underestimated repairs or whatever, that's why I enjoyed doing wholesaling when I was getting into real estate, just because it helped me kind of get my foundation. But you don't have to do either of those things. You can really just focus on owning long-term real estate, which if you do it the right way and you have a long-term mindset, I think this is a fantastic way for you as a beginner. And then ultimately you want to set realistic expectations. And this kind of comes back to your goals. What are your goals going to be? If you said 100 properties in 10 years, I mean, if you have the capital, then fantastic. But I would say, thinking small, I would probably do no more than, in 10 years, 50 rental houses. And that to me would be more of a realistic expectation. I've got friends who have had hundreds, over 100 rental properties in our city. And, but they were accumulated over a period of time. What I have seen is people get in trouble when their expectations are, I'm going to own 50 in 1 year. That doesn't typically work. It's not really a great way to do it because they might end up getting burned. I knew somebody who bought 20 at one time, and it was a mistake for this person. All right, next thing you want to do is we want to find our market. Are you going to buy locally or are you going to buy out of state? A lot of out-of-state people that we deal with are in Cali, they're in New York, they're in Florida, some are in other countries. And so you just need to understand, are you going to buy in your backyard if you live in Los Angeles? You can do it, but are you going to do it? So are you going to be local or are you going to be out of state? Now, the way you should look at this is, I think the closer you are to your real estate, the better. But if your market doesn't really give you many opportunities to invest and produce cash flow, then a lot of people look out of state, and that's perfectly fine. I would just be careful of chasing cash flow to to areas where you think, well, this is just going to be the best cash flow because they're the cheapest properties. I think you just need to be careful. And so we'll talk a little bit about what this might look like, but understand, are you going to buy in your backyard or are you going to buy it out of your backyard? I knew an investor who started buying in his backyard, actually in California, and he started buying just one at a time. And over 10 years, he accumulated 10 rental properties in California, which obviously over the course of that 10 years, they appreciated really well. He was able to pay down the mortgages, not all the way, but was paying them down. They appreciated. He sold that whole portfolio and then 1031 exchanged it into an apartment complex. And then he and his wife, within 10 years, replaced both of their six-figure incomes. That's fantastic. If you can do that, great. Most markets may not have that type of appreciation that's going to allow you to flip it and buy a massive apartment complex. But again, you can do it either way. Local, you can drive it and look at it. Out of state, you're going to rely on your team to give you updates and see what's going on. And again, this goes back to learning everything you can about your market. I would, the way I like to look at this, if I were going to draw this, let me see if I can draw this real quick. I would look at this like, here's the city. This is at the top of my funnel. Is it a good city? Are they creating jobs? Is there innovation going on? Are people moving into the city, into the state? Is it a landlord friendly area? So I look at top of the funnel, I look at the city, and then the next thing I like to do is I like to come down and go, okay, now that I know the city, I'm going to choose my neighborhood. So I want to know my neighborhood, this place that I'm investing in, what are the best neighborhoods that I can invest in. And you're going to find in any given city, there are all kinds of different areas, neighborhoods that you can invest in. And the way I like to look at it, I like to look at A-class neighborhood, B-class neighborhood, C-class, and D-class. Now, A-class is going to be your very expensive real estate, the best real estate in that market that's going to be the most expensive. It's going to provide you the least amount of cash flow, and there's just not a lot of opportunity to own rentals there because it's owner-occupied mostly. B-class, investors love B-class, especially if they're risk adverse. They want to make sure that they buy a great house that they could sell on the retail market or they could sell to an investor down the road. And B class is that good upper middle class neighborhood. It's always going to have some appreciation. And again, it's not a big rental area, but it's a great area. People love these. But a lot of investors that are buying, especially out of state, are looking for that C class. And C class is just good working class neighborhoods And what this means is that people are out, they're working, they have a steady income, the houses are solid, they're typically going to be 3-1, 3-2 mix, but they're great properties. They will experience some appreciation, not going to be like A or B class, but they're just solid houses. They tend to be great long-term holds. And then you have D class, and D class is going to be high crime. More than likely, the properties are going to be a lot older. There's going to be more wear and tear on those properties. And so you really need to understand what you want to buy. Understand the city, then understand the neighborhood. And then finally, I look at the house. So that's the way I'm breaking this funnel down from city to neighborhood to house, the type of house I want. If it's a C class that I'm looking for, then I'm looking for a 3-bedroom, 2-bath house. 3-bedroom, 2 baths. I'm looking for around 12 to 1,500 square feet. I would love a brick rancher. That's my favorite buy box. That's the kind of house in a C class neighborhood that I want to have. 3 bedrooms, 2 baths means that there's going to be enough for a family if people have kids or whatever. And I love brick. There's a lot less maintenance on brick. These houses were typically built in the maybe 60s, 70s, 50s, 60s, 70s, and they're just solid houses. That's me. You need to decide what's best for you, and you can do that just by doing your research and understanding that. So now that you've figured all this out and you've come down to the city, the neighborhood, and the house, that's great. Next, what we want to do is make sure we have the funding. I'm not going to spend a lot of time here. You need to know, hey, what is your credit score? If you're going to do this by yourself, you want to be in the 700 to 800 probably if you're going to go out and start borrowing money from the bank. Some of you may already have the cash, which is fine, but you can get traditional loans for these. I know that it just kind of depends on how many houses somebody will let you buy. Traditionally, it may be 4, maybe the limit. It could be 10, but you can probably sit down with your banker and figure this out if that's the way you wanted to go. I have friends that also do HELOCs, and HELOC could be great if you've got a lot of equity in your house. Over the past several years, especially since COVID, we've seen a lot of appreciation. So you may have a lot of equity. And so what I've seen people do is take a home equity loan. They go and pay cash for a property. They use that money to rehab it, and then they refinance it out and pay down their HELOC again. And then they have that cash ready to do another one. So that's to me, a very easy way to do it. Another way that a lot of people probably should do, especially just beginning, is just a JV. It's just like joint venture. Find somebody who has the money, or if you have the money, partner with somebody who'll put in the sweat equity. Either way is a great learning experience, whether you have the money or whether you have the time and you can put in the sweat equity. I know plenty of people who do this. This goes on every single day. There are people who are out there, and I've got a friend who does this. He puts in all the sweat equity. He's got the contractors. He picks out they flip houses. So he picks out the design and everything they're going to do inside. He manages it all. And he and his partner split the profit at the sale of the property. That's one way to do it. I have another friend in a different JV partnership. And so there's a lot of ways to do this. And this friend just has a couple $100,000 in the bank, and he allows a real estate investor to borrow on that when he's buying properties. And he just pays my friend like a 10% return on his money. And my friend doesn't need he says, I don't care about splitting the profits. I'm fine if he takes the profits. I just want my 10%. There's people out there like that. They just want to return on their money. So you can do this anyway. You can split this thing up as many ways as you can think of. And then there's hard money loans, and hard money is just, they're going to have a higher interest rate. So maybe they're at 13%, maybe they're at 15%. I'm not sure what the rates are right now, but you can contact a few hard money lenders and you can find out. What they usually do is let you borrow the money to buy the property, maybe even borrow the money to fix it up. and it's all going to be based on ARV of the property. So if there's a $200,000 house ARV and you're buying it for 100 and each 20 in work or 30 in work, they may loan you the whole 130 because it's got a $200,000 ARV, and you're going to pay it's meant to be a short-term loan. So you want to buy the property, you want to fix it up as quickly as possible, and then you want to sell it, or you want to refinance it if you're holding that for rental. You want to refinance it, pay them back, and then you have a much lower rate. Now your HELOC is going to be, right now, I don't know, maybe 8%. I didn't do that right. 8%, maybe 7%. And you're just going to be paying interest only on that. And then JV partnership is whatever terms you can come up with, I think, is what the JV is going to be. The whole point is, once you've chosen your area, your neighborhood, and your property, then you want to get the money ready. Then you want to be able to pull the trigger. Then the next thing is choosing the right property. So I have a few thoughts on this, especially for beginners. I would choose something that is in minor need of repair. It just needs a few repairs, not something that needs a massive overhaul. I don't think beginning you should deal with foundations. Like there could be a great deal out there and there's a foundation issue. It's got cracks all in the wall, and that's going to be costly if you don't know what you're doing. It could be more expensive than you think. I would just choose something that needed paint, flooring. The ones that we used to love are just the outdated houses where maybe a family inherited the property and we were able to buy it. It's like 70s or 80s still in the house, and it's going to be much harder to sell on the retail market. But for an investor, we love those houses because we can come in there and just cosmetically update. We can redo the kitchen, we can redo the flooring, take all of the wallpaper off and paint the walls. That is a great investment. Again, you don't want to, you just want to avoid the foundations. I would avoid anything that just where you're going to have a price tag of, $40,000 to $50,000 to repair that property. I would avoid that. Again, just don't want any major repairs. Then the other thing to think about is just cash flow. Now, there is a 1% rule. We haven't seen this rule play out recently in this type of market. Back a while ago when money was cheap, you could find that. And when properties weren't appreciating so much, you could find the 1% rule. You don't find that much anymore, but I would say you just need to know that it is going to cash flow. So you can figure that out, and we'll do another video about how to analyze rental property to understand what your return's going to be based on very conservative numbers. But you just want to make sure that you're not paying into that property. You want to know that it's going to cash flow. So to do that, you've got to make sure you have all your repairs, maintenance, ongoing plugged into your numbers. We're going to talk about that in just one second. And then for me, if I'm starting out again, I'm going low crime, good job growth, and good schools. Those are C and B class neighborhoods, mostly. And I would focus on those. 100% would focus on those. And just know, the great thing about this is just know that if you have an area like that, low crime, job growth, and then great schools, you're going to get that appreciation along with paying down that note. And you're also going to get something that a lot of people don't think about is you're going to get rental appreciation as well. So your rents over time are going to increase. We've seen rents increase over the past several years, like majorly, but it's not typically that way. It's starting to settle back down. But good, steady rent growth is something that will also come if you choose the right property in the right area. All right. How about this? How about the never buy list? I'm just going to put a big X by this. Like I would never, or maybe this should be red, right? You never want to buy these properties. I would say anything that is 100 years old, I would avoid. I would avoid this. I have bought houses that were built in 1905, 1910, 1915, whatever. They don't work out. mainly because, or at least especially new investors, they don't understand how much repairs will go into this property. There's going to be so many repairs that need to be done because they're older. A lot of times these houses have really high ceilings. And so what happens is you move a resident in and they have to heat and cool this with high ceilings, and it costs them more. And they're like, well, I can go get a really efficient 3-bedroom, 1-bath, 3-bedroom, 2-bath, 1,200 square foot, 8-foot ceilings, 9-foot ceilings, and do a lot better. Save a lot of money. That's why I avoid older houses. You're never really ever going to be prepared for long-term maintenance on those houses. I have bought them. Trust me, you don't want them. 100-year-old houses, expensive. You don't want to be the most expensive house in the area. I'm even saying if you're in a B-class area or a C-class neighborhood, you don't want to be the most expensive house. You want to be in line with most everybody else. I would encourage you, buy the normal house. Don't think that somebody's going to love your house because it's really nice and has all these custom features. Don't buy into that. You're talking about residents, and these are people who are renting properties. They just want to have a normal house. They want to live in there, hopefully for a long period of time, and then they want to leave. And you just don't want to be stuck with something that you're going to have to sell one day, and it's going to be a lot harder to sell the most expensive house in the neighborhood. I'm going to tell you as a rookie, avoid high crime neighborhoods. The temptation for investors is to buy in these areas because these high crime areas provide potential for higher cash flow. But what you'll find is a lot of investors, it doesn't wind up that way. They get enamored with a spreadsheet, right? So don't buy into the spreadsheet. If I could reiterate this, everything looks good on paper. I was just looking at a deal the other day where a turnkey provider was trying to sell this piece of real estate, and the high crime area that it was in was bad. They underestimated repairs. They overestimated appreciation. They underestimated taxes. I mean, there's so many things that a spreadsheet can get you to believe that's not going to be reality. And the challenge is that you're going to wake up one day and say, hey, this is a horrible investment. I'm losing money. And then you're going to blame whoever is managing the property, or you're going to blame the person who sold it to you. And the truth is you should have never bought it in the first place. All right. So avoid high crime areas. I'm just going to tell you, you're going to have more problems. And part of the reason we don't like low income and high crime areas is because people have personal issues that happen all the time in life. It doesn't matter where you live, most expensive neighborhood, poorest neighborhood, doesn't matter. Everybody has issues. Everybody has problems. The issue comes if you lose a job and you're living paycheck to paycheck, and then all of a sudden you can't pay your rent. If you're in a super low income, high crime area, this may happen. People are less likely to have cash reserves to get them through a bumpy road, a bumpy time in their life, which everybody has. So again, you can mitigate that risk by just kind of buying that B or C class neighborhood. And then white elephants. What is a white elephant? I'm going to draw an elephant here. That's not too bad, is it? Avoid white elephants. Why white elephants? The thing about white elephants is if you saw a white elephant, you couldn't ignore it, right? You've never seen one before in your life. You couldn't ignore it, and you'd be like, what? This is a white elephant. I've never seen one. You can't ignore it, and you can't do anything about it. If you wanted to get this thing out of your way, you can't go up and push a white elephant out of the way. It's way heavier than you, and there's nothing you can do. So what are white elephants? White elephants are, let's see if I can get it in here. They are busy streets. They are train tracks. They are funky layouts of the property. There's a reason why D.R. Horton sells millions and millions of houses, because they create cookie cutter floor plans, the floor plans that everybody wants. That's it. They don't try a funky layout. So if you walk through a house or you get pictures of a house and it's got a weird, like somebody has to walk through a bedroom to get to the kitchen, just stay away. Like, it's going to be harder to rent. I would say if you're in a cold area, steep driveways. All these things are white elephants. Power lines. Anything like that, just stay away from it. Just avoid those white elephant issues because, again, it's going to be harder to rent. So now you've decided the area, you've gotten your financing, you've decided what you're not going to buy, what you are going to buy. The never buy list is really important. Then next, you're going to just start searching for deals. And I would say if you're going to do it by yourself, then these are the places: MLS, Zillow, Redfin, Realtor.com. All these things are going to be syndicating out to the same places. You're going to see a lot of the same houses, but you can just search. You can set up alerts for certain areas. You can look at houses. I think you should look at a lot of houses, honestly. You should look at a lot of houses. You could also network. You could start going to RIA deals. If you're buying in your own backyard, you could start going to RIA meetings, which is like RIA, REI, which is real estate investor meetups. You can do that. You could even if you're not buying in your market, you might want to still go to those meetings and just learn from others. The people standing in the back of the room are the people that do a lot of deals. The people sitting in the front rows are there to hear a speaker. They probably aren't doing deals. I would go and hang out with the people in the back of the room and just get to know them. You're going to learn a lot. You may even find somebody who wants to mentor you. The real estate industry is really cool because you do have people that want to help, and a lot of them don't like sell courses. So you can just ask for advice and they're happy to give it to you. Again, you can attend auctions. I've not really ever done this. I've not gone and bought a house on the courthouse steps. I know people who have. That's just not for me. But I would say always stay disciplined to your buy box. Now, the buy box is exactly what we talked about. For me, it's the 3-bedroom, 2-bath house. It's no more than 1,500 square foot, and it's a brick rancher. Your buy box could be completely different, and that's okay. You just need to decide what's best for you, and then you can commit to it. To me, once you have that buy box, you eliminate 90% of the properties out there. You just eliminate them. Who cares? All you care about is what you're committed to buying in the certain area. So it's going to give you just a limited scope. And there are other investors who have a different buy box. So you aren't competing all the time with somebody. And then the last thing is just patience. Patience. Again, I mentioned this. This is a get rich slow, not a get rich quick thing. And so you just like this, again, you've already set your target for 10 years. By nature, we want immediate gratification. We want to hit the easy button. We want everything done for us easy. We want the quickest way to $100,000 so that we can leave our job or whatever the case is. If you're patient and if you stick to a plan and if you stay disciplined, you can go very, very, very far with real estate investing. We know this. We see this all the time. We have investors who have built tremendous amounts of wealth over the years just by simply staying steady. They're hitting singles really every single day. It's just hitting singles. Nobody's trying to hit a home run. People who try to hit home runs strike out a lot. Again, I have seen investors who've bought too much too fast and gotten burned and lost hundreds of thousands of dollars. So don't do that. Just be patient. And then the last thing you need to do is make an offer, right? So you can work with a friendly, a real estate investor friendly agent, which I would suggest, not a retail agent, an investor friendly agent. These people are used to making offers like this. They know the areas of town that investors like. So you need to find them. We've got a list of cities that we have agents in, but you can find the investor-friendly agent, and they absolutely will know how to find you these deals. Again, it's a numbers game. I used to I used to make, so this is the deal. We used to get around 100 leads to buy, this is to buy houses, 100 leads a month. We automatically disqualify like 50% of them. We may make 40 offers and we would buy 3 to 4 houses a month. That's what we would do. So 100 leads. So for you, if you think about this, you may look at 100 houses. You may think, wow, 40, I found 40 that might fit my buy box. And you probably aren't going to make 40 offers. I mean, that's a lot. This is what I was doing full time. You're not going to be doing this more than likely full time if you're just starting out. You may make 10 offers, and you may make 100 offers before you buy your first house. That's okay. Just stick to your numbers. Whatever number that is that fits, stick to it. We do have a cash flow calculator. There'll be a link below this video. You can where'd that go? You can click on that link. It's free. All you have to do is save it as a copy, and then you can use it. It's going to give you a great way to break down all the numbers. It'll make sure you put everything in that you need to: financing, repairs, renovation, fees, expenses, insurance, taxes, all this stuff. I highly encourage you. You can download that. It's absolutely free. So you want to make sure you have all the numbers really before you make an offer, right? And then once you make an offer, you're going to get an inspection. Now, this inspection should be by a professional. Now, your agent can give you a ballpark figure. Your agent should be able to go, you know what, I think probably, I don't know, probably going to be $15,000 worth of work. That inspection that person's going to go out. They're going to find other things. So you may make an offer based on your eyeball test. You may make that offer, but you're going to have a period of time where you can go and have an inspection. You should have that because it may reveal things that you didn't know, or it may reveal to the positive or the negative. More than likely, they're going to find more that you weren't aware of. And then what you're going to do is you're going to come back and make that negotiation, right? So if you were buying this $200,000 house for $100K because it needed $50K in work, you may come back and say, well, it really needs $60K in work. I can only buy this for $85. Your offer was $100, and again, you don't want that much in repairs. Maybe a better number would be you were buying it for $120 and it needed 10 in repairs. Whatever the case is, you can come back and negotiate. That's what you're going to do, and you just need to be prepared. If they say yes, you're going to take it. But that's what the inspection allows you to do. And then ultimately, you're going to close that deal. And that's going to be a great day because then you're off to the races. You figured this out. You are buying this property and it's yours. Now, you got to think, well, how am I going to manage this property? There's a couple things you're going to need to manage. Your agent can help you with. You're going to need to manage the renovation, and then you're going to need to manage the marketing of that property, You're going to need to manage the underwriting of the resident and then placing the resident in there and collecting rent, all those things. So are you going to do it or are you going to have somebody else to do it? Now, if you're buying in your own backyard, can you do this? Yeah, absolutely. That just, if you have the time and you want to do that because it's a great learning experience, which is the way I learned, you 100% can do that. Absolutely. You can do it. You may even be in your backyard, but you're like, hey, listen, I have a high paying job. It's not worth my time. The time that I get paid, it's not worth it to come and deal and show the house to potential residents unless you want to learn. Then you will find somebody in your area that you can trust to manage that property for you. If you're out of state, you can manage it from out of state, but it's going to be a lot harder because you probably don't have the relationships in these areas. Now, if you have really good friends who want to be a part of this in that state that you're buying in, then maybe you can talk them into a JV deal or whatever. But you're going to need to build the team. And so I would say this team is going to need to take care of maintenance. They're going to need to screen and manage tenants. They're going to need to show the property. These are the people you're going to need on your team, you or this person is going to need to keep up with property laws, what's changing. Some areas, some municipalities are going to be a lot more difficult to navigate than others. For instance, I know that in Detroit, Michigan, there's a lot of regulations for rental properties in and around the city. Even if you're not investing in the city, there's still a lot of regulations you got to follow. I know in Colorado, a lot of laws have changed recently. So there's just different places you need to understand and keep up with property laws. You need to be able to follow fair housing, and then also market trends. What's going on in the market? Nobody's going to know better about the rental market than a property manager. So this is why we see a lot of real estate investors, especially out of state and out of country ones, contact us and say, I need help with how much is this house going to rent for? We're happy to talk to people about that. We do that every single day. And then, like I mentioned, just property managers. There's great property managers all over the country that can help you depending on where you are. You can find them. I would interview a couple of them, make sure they knew what they were talking about, and then I would hire somebody if you didn't want to do it yourself. Then, this is the last thing we're going to really kind of talk about is I'm a big believer, if you're going to buy one property, you need to plan on buying 10. Buying one, buy 10. Buying one is not going to really help you very much unless it's, unless you just are inheriting a rental house and you're just like, hey, I want to give it to my kids one day and you just want to have that one house, fine. But I would encourage you, if you're going to buy one, think about buying 10. It's going to provide you with more consistent cash flow if there's a vacancy, if there's a big repair, maybe a CapEx expenditure like a roof or HVAC, that cash flow is going to help you out. It's going to keep, it's going to make sure that you're not like just totally struggling if you borrowed money to buy that house and you're not having to come out of your own pocket. Again, this can be done over time, should be done over time. And you get to decide how quickly you build that portfolio. But I'm just going to encourage you because vacancy is going to happen. Non-payment at some point is going to happen. And I say this because people have struggles in their life, like everybody does, right? This is not news. And so if somebody loses a job, what are the problems that people have? Loss of job, health issues, divorce. Those are 3 big ones that can prevent somebody from paying their rent. If you have one house, one property, then that's going to be a bigger issue for you, especially if you have to evict somebody, especially if you have to get them to, you could lose not only 3 or 4 months of rental income, but then it's going to cost you to evict that person $500,000, $2,000, whatever the cost is in that municipality. And it's going to be just a big pain in the butt. And then you're going to have to go in there, you're going to have to fix the house up, and then you're going to have to re-rent it again. So we're talking months of lost rent, not to mention the expense of fixing the house up and getting it back on the market. If you have 10 properties, this is much less of an issue because it may happen to 1 out of 10. And then, of course, you could use your additional cash flow for just different repairs that you have. It's really simple. So this is it. Let's just do a really quick recap. I think this has been a lot for if you're a beginner. To me, I've covered everything that you need to know, everything you need to be thinking about. Again, setting goals is really, really going to where you start. Find your market, get your funding all together, pick the right property, but remember our funnel. We want to go down from the area to the neighborhood to the house. And then your never buy list. Don't buy these houses. And then you're going to search for deals, make offers. And then lastly, just making sure that property is managed correctly. You want a great experience for the person you're renting it to as well as yourself. This can be a win-win situation. We see it all the time. It's a win for the resident. They have a great place to live. They have a clean house. They have a safe house. They love the neighborhood, and then it's a win for you because you are not only providing housing for somebody, but you're also receiving income, rental income. All right, so that's it. If there's anything you think I've missed, I'd love to hear from you. Why don't you say something down in the comments and tell me if I missed a step or if you didn't agree with a step, whatever the case is, would love to hear from you. And then subscribe to our channel, like this video, share it with people if you found value. And then we hope you come back to our channel because we're going to continue providing value and excellent resources for real estate investors who want to grow rental portfolios. All right, that's it. Hope you enjoyed it. See you next time.